Hey guys, Justin and Marcus here from Make Money Count. There was some pretty big news yesterday. Depending on when you're watching this, the Bank of Canada raised interest rates yet again, but they did say they were going to put a bit of a hold on it, or they plan to. So today, Marcus put a bunch of graphs and data together for us to look at. Sounds boring, but Marcus is good with making boring things exciting. So I know that you put a lot of work into this. I'm really excited, and so let's get right into it.
Not as much work as the people that put all the data together,
Right?
Like that compiled this data.
Yeah,
So we got some really good stuff.
Mm-hmm.
I know it's boring for you.
Mm-hmm.
Like that's not lost on me.
It's not that boring. It's interesting, and you make it interesting. That's why I love to be here with you.
I had a hard time with this because this is our first show back.
Yeah, we haven't done a show in a while.
So I had a hard time with this because I've been saying the same thing now for what feels like 2.5 years.
Okay. Yeah.
Right?
Mm-hmm.
And I usually just like take in a lot of this data and all this information and then form my opinion and prognosticate what I think is going to happen.
Mm-hmm. Mm-hmm.
But I think from some of the comments and some of the emails that we get, people want a little more information on the why.
Mm-hmm.
Like, how do you arrive at this?
Yeah.
Like,
absolutely.
Okay, real estate prices are going to go down more?
Great.
What?
Yeah.
How come?
Yeah.
What tells you that?
Mm-hmm.
Interest rates 5-year fixed rates are going to go down from here? Why? But the Bank of Canada just increased rates by 25 basis points.
Yeah.
Why?
Yeah.
What am I going to do? Right? Like the big questions right now are, I've got a 5-year fixed rate mortgage at 2%.
Mm-hmm.
And I got 3 more years left on it.
Mm-hmm.
But my business isn't doing well.
Mm-hmm.
And I need money.
Mm-hmm.
What do I do?
Yeah.
And that question, in order to answer that question for somebody, you have to know, or at least be confident to some degree about what interest rates are going to do and in how long they're going to do it. Right? Because you're going to advise someone to break a 2-year mortgage to get $100,000, and then they're going to move into a new 5-year fixed rate mortgage at 5%.
Mm-hmm.
Well, depending on how much money they have on that mortgage, they're going to increase their cost of borrowing significantly for that new money that they want.
Right.
Can they hold off? When are rates going to come back down? Or what about the person that has a variable rate mortgage?
Mm-hmm.
And they're saying to you, geez, I got a variable rate mortgage. When I got it, it was 8 Bank of Canada tightening events ago.
Right.
And I was at 0.8%.
Mm-hmm.
And now I'm at 5.8%.
Right.
Like there is, how do you answer a question to that person? Like they need money. They're in a variable rate. Do you tell them to lock into a fixed rate? Then they lock into a fixed rate. And then in 12, 18 months, fixed rates are significantly lower than where they are right now. Never mind. In 3 months, fixed rates will be lower than where they are right now.
Yeah.
And then they need to break a fixed rate to pay a really hefty penalty to go into a new 5-year fixed rate. Should they take a variable rate? Variable rates are higher than fixed rates. So in order to answer these questions, you've got to have an idea as to what is happening in the economy and what's going to happen. More importantly, what's going to happen next. Like I always complain, you're not at Navy Wharf as often anymore, but I always have it on like CNBC or BNN.
Mm-hmm.
And I always complain. And I don't know, I'm crazy. So I like talk to the TV screen and I'm like, I don't understand these people. I'm staring at the screen. I'm like, these people can only tell me with certainty why something happened.
Right.
Nobody can tell me what's going to happen.
Right.
Nobody, like everybody's got like, so if the market is down, then they bring on all of the bears. So they come on and they're like, we are bearish on the market. This is why we're bearish on the market. This is what we've been saying. And that's why the market dropped today.
Mm-hmm.
And then next day the market goes up. So they just bring in all the bulls. And the bulls come in. Bulls are people that are positive on the economy and the outlook for the economy. And the bulls come in as the bears were wrong.
Yeah.
We told you. That's why things are going up.
Mm-hmm.
Tomorrow's going to be the same. And then guess what? Next day, market goes down. Inside of all of this volatility, a lot of people are making a lot of money.
Right.
And the average homeowner is sitting there like, what?
Mm-hmm.
I don't care. Like, tell me. Like, I'm now being strangled by high interest rates and inflation simultaneously. Because everything I want has gone up in price. Everything I need has gone up in price. And now my cost of borrowing has gone up. So I needed to borrow money to pay for all these things that increased in price. And now even the money that I'm borrowing has increased. So the idea of today is to go through some of the data points that I've seen that I found interesting and to provide that data to you. And then you ask me questions.
Right. Done.
So you say like, okay, like what does this mean? And honestly, I know you. There's two things about you that I really appreciate. Number one, you don't really get embarrassed very easily. So like you won't be afraid to ask a question. You'll even preface it sometimes. You'll be like, okay, dumb question, but I want all of those questions.
Okay, done.
Number two, you're actually kind of dumb. So like you know, like you will ask those dumb questions. And I think that's great. So you'll do two things. You'll allow the audience.
I hear Matt snickering in the background.
No, I think that you're of average intelligence. But
Thank you.
The average person's also pretty dumb.
Thank you.
That's not what I'm saying. That's not what I'm saying. Okay, so I think that Justin is extremely smart and extremely intelligent. I just think that
I didn't go to university economics class.
I mean, never mind. You could just take out economics. You could just take out economics class. I know you didn't go to university.
Yeah.
I mean,
what about college economics?
What about high school math? Right? But that's a good thing because you're going to do two things. Number one, hopefully we're going to get the audience comfortable around the things we're talking about. And hopefully by you asking the odd, really dumb question, the audience is going to be like, whew, I am smart. So without any further ado, I got 10 slides today. Okay, first slide.
Okay.
So this slide I like because it's basically like every time that the Bank of Canada issued a monetary policy report, so a report as to how monetary policy is doing over the last couple of years, they have changed their forecast for inflation. And there's a lot of colors on here because there's a lot of reports. But what this shows you is that since October of 2020, which is the first monetary policy report, the inflation expectation of the Bank of Canada has been consistently revised upwards. So October 2020, we were doing a podcast and the Bank of Canada and the central bank in the United States, the US Federal Reserve, were telling us inflation is transitory.
Right.
Inflation is good. Right. We need inflation. There were some central bankers were coming out and they were saying like, oh my God, it's so good. There's a little bit of inflation. It means the economy is breathing signs of life. This is great. We want to see inflation.
Right.
So that happened in October of 2020. You can see just like below 2% was the expectation for a year out. Everybody was happy. Interest rates were at zero. The money press was going full speed. Yeah. Bing. Like Trudeau was at the strip joint doing this, like flicking out
spending
ones.
$7,000 on hotel rooms.
There was twerking happening. It was a free for all. Nobody was working. It was like, it was a party.
It was a party.
Somebody should have told us.
Yeah.
Somebody should have told us.
Yeah.
And then January of 2021, the little green line that's on there, little bit more inflation, just creeping into that 2% mark. expected kind of, they were at that point, they were like, well, listen, in 6 months, 6 to 9 months, we might see inflation creep to the 2% mark, but then we see it falling down again promptly, and 2% is within the Bank of Canada's range. So we're not worried about it. Keep the printing presses going.
Mm-hmm.
And then in April of 2021, they were like, okay, no, inflation is running a little bit hotter, a little higher than we usually want to see it, but we're still okay with it. It's transitory. It's going to come back down in line to 2%. No problem. And you can see the trend, the progression here, right? Every consecutive report that comes out, the Bank of Canada says, okay, inflation is becoming a little more of a problem.
Right.
Until we get the July of 2022 report. So can you imagine from April of 2022, which is the red line, to July of 2022, which is the teal line?
Teal, yeah.
Yeah. Can you imagine that revision? Like somebody at the Bank of Canada was like, oh shit, boss. Looks like inflation's tracking a little hotter than even we anticipated last time. We thought we were going to peak out at 6. This puppy's going at 8.
Yeah.
If you were to, like, it's a good thing that you ever watch those movies where like the astronauts have to get the spaceship to come back down to Earth?
Yeah.
And then like the only tool that they have to get it back down is like this little joystick that like lets out a little fart like on the side of the spaceship. Like it's just like they push the joystick. It's like, and that little, like it changes the course of Apollo, whatever, so that it like actually hits the size of a pinhead. You know what I mean? Like Matt Damon saying to George Clooney, George, we only have one little fart left in the machine. And George is like, all right, give me 1/18 of a fart, Matt. And they land on a postage stamp in Tacoma. Well, just to tell you that thank God Tiff Macklin wasn't in charge of that joystick.
Yeah.
Because we, instead of landing on the postage stamp in Tacoma, are in Pluto right now. Tiff Macklin was going. So you can see like the joystick was broken.
Yeah.
Inflation came in hot and heavy. And the other problem, I think, what central bankers and what data can't really truly account for is the greed inherent in inflation.
Right.
Because once inflation creeps in, you get companies that claim inflation as the problem, but really use that tagline or that theme in the economy to pad profits.
To jack it,
right?
yeah.
And we've seen that happen. Like Canadians are really pissed off with Loblaws right now, right?
Right.
Loblaws has massive profits over the last couple years that are kind of in line with what inflation was.
Right.
And now people are starting to call them out. It happens across all different sectors.
Right.
And typically service sectors are the ones to kind of relinquish those ill-gotten gains last.
Right.
But what this shows you is just the Bank of Canada was wrong about inflation. Every central bank was wrong about inflation. And that's why we're here.
I have two questions about this. This graph. So if I'm seeing, if I'm reading this right, we're actually trending better than what we.
Good one.
We're trending better than what we thought we would be in July. So that's good news.
So the black line is from October of 2022.
Right.
There is a new monetary policy report that will be issued now.
Right.
And I expect that report, based on what we saw, that inflation is as of now at that 6% mark.
Right.
Which they October of 2022, they've got us hitting the 6% mark in Q2 of 2023. We hit it earlier.
Right.
So we are coming off of that kind of smoking hot inflation reading sooner than what was predicted in the 2022 October of 2022 report, which is good news.
Yeah.
So I think that in the end, we will probably end up closer to the April of 2022 trajectory. And I hope that we will actually see inflation come off even steeper than that. That 2022 trajectory has us kind of back around 2% in Q1 of 2024. I think it might even happen sooner than that.
Really? That was my next question. Was like,
This is like the magical question that everyone's asking.
Believe this?
Well, what's what I was going to ask, Marcus, is that there's that big drop between this quarter and the next quarter here where it drops almost 2%. We never even saw except for over here at the beginning, this 2% jump up here, but this 2% drop is and then it kind of goes stagnant. So what do you think is going to happen between here and there there's a big drop and then it kind of goes stagnant?
I'll give you a hint.
Rates, right?
No, to why inflation is going to drop that much?
Yeah.
It will be the impact of what we've already done on rates. So you want to let's switch to the next slide, and that's a great leading question into what we're going to talk about. So this slide shows you on a dollar weighted basis the impact of this tightening cycle. So the blue line is this tightening cycle that we're in right now. So it's showing us that we went from 0 to 8 in the span of 4 quarters. The bottom line are quarters. The top line is the increase in rates. We didn't actually go to 8% on the overnight rate, but because there's so much debt in the market, Stephen Polos used to say this. Monetary.
You love that guy, eh?
I mean, I'm impressed by any central banker that can manage that many opinions and that much data in the face of politicians that are trying to guide what you're doing, a populace that needs people want immediate gratification. Politicians operate in 4-year cycles, and you need to steer an economy for a long period of time. So it's whatever. Anyone that's in charge of a central bank, it's a pretty impressive job, right?
Right.
Anyways, so Stephen Polos used to say that monetary policy has changed because a smaller increase or decrease in the overnight rate has a more pronounced impact on an economy because the economy has so much more debt in it, right? Again, back to the joystick on the
Post-it note.
Post-it note.
Did you say that?
No, the joystick on the spaceship. The postage stamp to land on the postage stamp. Yeah.
Oh, postage stamp. Yeah.
Yeah. Much smaller than the post-it note.
Yeah.
Anyways, so the impact that we can anticipate from the most recent tightening cycle is probably a change from 0% to 8% in the overnight rate.
Right.
And in the past tightening cycles, the most recent one being 1994. Well, the most recent big one was that 94-95, which is the green line on there. We really, over the same period of time, over that 4-quarter period, we went up by about half, and it had a really big impact on the economy. Then there's 97 to 98, which was a little more drawn out. And then there's that 2004 to 2007 tightening cycle, which was really kind of much longer, probably more of what a central banker would want to do to respond.
This guy was in charge of the joystick.
I mean, you could argue that maybe he wasn't based on what came afterwards, but yeah.
Right.
Yeah. So this is just to show you that what we have done, not just Canada, but what the central banks have done in the last 2 years in the last year, really, because if you look at that, the change from the second quarter to the fourth quarter went it's 2% to 8%, right? That's a 6% hike, kind of adjusted obviously for debt levels and things, but that's a monster change inside of 1 year, 4 quarters. Think of that axis from 0 to 8 is the adjusted interest rate of the overnight rate for debt.
Right. Okay.
Okay. So it is, think of it, all things being equal, we went from 0% to 8% on the overnight rate
Right.
because there's so much more debt. So let's say all things being equal, if we had half the amount of debt that we have,
Mhm.
like we did maybe in the 94-95 cycle,
Mhm.
we would have gone from 0 to 4 inside of that 2-year mark, kind of like the green line. But because we have double, maybe more than double the debt, I think we have double the debt from even the orange line. Like from 04 to now, I think we have double the debt, double the consumer
Canada,
debt.
yeah.
So it's just to say that we don't, like, we can't really fully appreciate just how impactful that's going to be on our economy.
Right.
So which brings us to the next slide. This is inflation over interest rate. So the key interest rate, the overnight rate of the Bank of Canada, it shows the massive increase from January of 2022 to January of 2023. Everyone's more than familiar with that now.
Oh yeah.
And then it shows the inflation rate as it's been tracked to now. And you can see that it's coming off. You can also see that we have done nothing to reduce the overnight rate. In fact, the only thing we've done is in the last meeting, which was yesterday, the governor of the Bank of Canada said, all things being equal, based on what we're seeing, we're probably going to leave rates where they are right now,
Right.
which is good, but maybe it's too late.
Right.
That's what I'm going to say right now.
Right.
My worry is we increased rates too much. We forgot one of the most important things, that monetary policy has a lag.
Right.
There's actually different types of lags in monetary policy. There's the initial lag where they're assessing.
Mhm.
So like they get data in and they need, well, first the initial lag is what indicators are you paying attention to, right? Because some indicators are leading indicators. Some indicators are lagging indicators. That's actually the term. It kind of confuses what we're trying to talk about right now.
Mhm.
But some indicators kind of foretell what's going to happen, and some tell you what's already happened.
Right.
So taking in all of these indicators, and inflation is considered to be a lagging indicator,
Mhm.
right? It's already happened.
Yeah.
Tell me
Too
something
late.
that's going to tell me when inflation is going to come in and how I should respond to it quicker.
Mhm.
So monetary policy, though, is known to have a lag. Now, one of the ways they combat that, central bankers combat that, is to use economic policy as theater, to talk about interest rates. Oh, we're going to get really tough on rates.
Yeah.
We're going to raise rates forever.
Right.
Rates are going to just, like, you're going to look at rates. You're not even going to recognize them in a year. You better stop spending money. You better stop borrowing money. Like, that is economic policy.
Yeah,
That's monetary policy. So these two statements are really important when we're thinking about what's going to happen to our economy next.
Right.
The most important thing is, historically, we know this for a fact, and many, many studies have been done on it. Monetary policy has a lag.
Right.
It has a lag up front because of the data. It has a lag while the central banker is processing the data to decide what to do. And then it has a lag based on its implementation and how that trickles through to the economy,
Right.
because it needs to get absorbed, right? Regardless of whether it's a negative shock or a positive shock. And we'll talk about that.
Right.
So, whether it's a positive shock because they're increasing rates or a negative shock because they're decreasing rates, right? But that absorption of the monetary policy is critical to how the economy is going to react.
Right.
Next slide.
Next slide.
So this was really cool. It's from the Australian Central Bank. They did a study
Mm-hmm.
on the impact of monetary policy on CPI. So in the first year, we see that there is about a 20 basis point drop in CPI from a 25 basis point hike in rates.
Right.
Okay.
Okay.
In the second year, there is a 40 basis point drop in CPI, double the drop
Right.
in the second year. And then in the third year, there is another, call it 20 beeps. 20 beeps? No, 10 beeps. This is to just show you, it should highlight the lag in monetary policy. Which, it's great that Tiff Macklin's saying we're going to hold rates where they are right now. But maybe he should have done it sooner, because we just delivered this monster blow of monetary policy to our economy as economic theater to pump the brakes. We're really worried about inflation. And inflation's now coming off fast. But what are the, this is a lot of change for an economy.
Yeah.
And when you make big changes like this, things break.
Right.
And we don't know what breaks. You never really know what's going to break.
Till it breaks.
Yeah. Okay, go to the next slide, Matt. This is just highlighting the same thing. Positive shock versus negative shock. So a negative shock means a cycle that we would have been in, a loosening cycle where we're stimulating the economy. So we're dropping interest rates. You can see the effect of dropping interest rates 6, 12, 24, 36, 48 months down the road.
These are the light blue bars.
In the dark blue bars.
Okay.
That's a negative shock, decreasing interest rates.
Right.
Light blue bars are increasing interest rates.
Okay.
So again, same thing. 25 basis point hike in rates. You got the baby blues over here.
Right.
Okay. Baby blues are telling you that, 6 months, 10%, 24 months, 22.5%, 36 months, 25%. Big change.
Yeah.
3 years down the road. This is on a basket of goods that consumers would spend money on.
Right.
We can put that in the slide, what the exact items are. But this one's not done by Australia. This one's done by the Federal Reserve.
Right.
So
not a country of criminals.
my worry, I mean, it's arguable.
Yeah.
So my worry is that we've done so much. We've hiked rates so much that we don't know what the impact is yet.
Right.
And it's actually, it's going to play out in the Canadian real estate market in the same way, because you've got so many people that are holding on to a house, holding on to rental properties, holding on to commercial real estate. And for whatever reason, whether it's they're in a fixed rate and they're locked in and they're not worried about it, but their rents are dropping because tenants are vacating, because the economy is weakening, or they're in a variable rate and the rents might be stable, but the variable rate has tripled what they need to pay on their mortgage, and they're worried because they can't service it.
It's scary.
Right. So for whatever those reasons are, people are still holding on. At a certain point, these shocks continue, right? The impact of these higher rates continue. And as it continues, people will have to release that real estate back into the economy. So we had, before the break, we had Ben Ferguson, realtor, on here. And we were talking, I was trying to get from him what he thought was going to happen to real estate prices. And I mean, not only is he's very candid, he's optimistic on the real estate market, because we have seen a drop about 15 points from the high. And he thinks we're kind of probably pretty close to the bottom. The problem with that is thinking that we're closer to the bottom than we were when we were 15% higher.
Yeah.
But we might have another 15 points to go. We don't know. We can't quantify it, because we can't quantify how much of the monetary policy shock has been injected into the market. We just know historically that we haven't seen it all yet. So this slide here kind of gets us into one of the factors that most people believe will mute the pronounced impact of monetary policy on real estate.
Right.
Population growth. Right. So Liberal government saying we're going to let in 500,000 people a year, 1 million people, whatever the numbers are. A lot of those people are going to end up in major cities, Toronto being one of those cities. So hopefully that this population growth will lessen the impact of these high rates over what will hopefully be a short period of time. Right. So those are the two things, I guess. Time, rates aren't going to be high for long, and population. Those are the two things that we can hope that will bring stability into the real estate market.
I have a quick question, actually, something that I should have asked you maybe on the last slide, but when we were talking about the real estate. So the most recent ban on foreign buyers, do you think that's going to also have a huge impact on our real estate market or no?
I don't know. I don't think so. I think that like where there's a will, there's a way. I think that
Yeah, that's
money migrating will find a way to get to where it needs to go. And there's so many like loopholes and ways around things that I think for sure at the initial, yes, it'll have an impact. Again, like that's an example of like a brain dead government.
Yeah.
Right. Like we had an idea when real estate prices were skyrocketing, and because it could not have been any fault of ours for printing money and handing it out to people and telling them to stay home all the time. It couldn't have been our fault.
Yeah.
It's clearly the fault of the foreign home buyers.
Yeah. Yeah.
Let's get rid of the foreign home buyers at a time when we need them to prop up some semblance of a market. Right.
Yeah.
It's too much tinkering from a government ends up in explosions.
Right.
Like the government tinkered and made the bomb, and now we got Trudeau sitting there with a pair of scissors and a red and a green wire, looking at which one to cut. He's gonna cut both of them.
Yeah, I was just gonna say he's gonna cut both.
Yeah, like
sure.
Anyways, we'll definitely hear more from the government in the coming 3 to 6 months about nonsense that they're doing. But it's always like the most backward looking assessments will come from our federal government.
Right.
Anyways, positive population growth.
Yeah.
It's going to spike up way higher than the long-term average. Only thing I don't like about this chart on its ability to impact housing prices
is it doesn't look like an eye squiggle.
No. It's like, look at the little eye squiggle back between 88 and 91.
Right.
You know what happened after that big squiggle? Is that property values went down. Like,
right.
From up until like 97, property values were going down. Anyways.
And why do you think that is if there's more people that need to like be in a home? Why do you
Because we had inflation prior and we had to kill inflation.
Right.
Just like we're doing now.
Right.
So, and then it kind of floated around, right? Real estate prices didn't start hitting their stride again until like 2000s, right? Late 90s, late 90s and 2000. And then real estate just went on a tear.
Right.
Like a 25-year tear.
Mm-hmm.
And now we're sitting here at the end of it trying to like hope that it doesn't fall off too much.
Right.
And the things that are going to prevent it from falling off too much are, number one, year-over-year population growth. Number two, hopefully that interest rates come down.
Mm-hmm.
But again, the only way interest rates come down is if the central bank sees inflation coming off, and inflation coming off means Canadians have to feel the pain.
Right. Yeah.
We need to go through this process of spending less because we are allocating more money towards servicing debt, borrowing less, spending less, prices come down. And then the kind of last bastion of those high prices is those kind of greedy companies that have kind of marked a line in the sand, and they're saying like, no, the lettuce is inflation.
Yeah. The romaine.
No, there's a reason why romaine's $12.
Yeah.
Inflation.
Yeah.
It's inflation.
I went to a restaurant the other day and they weren't serving Caesar salad. Like the option was the Caesar salad. Yeah. And they were like, we can't do it.
What were they using?
We can't even, no, they just didn't do Caesar salad.
Little torn pieces of paper.
Yeah.
They had anchovy dressing on it.
Like $20 bills.
Yeah.
Yeah.
Anyways. I think hopefully some of that stupidity is going to come out. Right.
Yeah.
The problem is it's greed, right? Like they took advantage of the situation, and that is leaving our economy in this precarious position. Mm-hmm. But it's a natural behavior of these corporations. Same way a bank doesn't work for you.
Yeah.
Loblaws doesn't work for you, the shopper.
Mm-hmm.
Loblaws works for their shareholders.
For Galen.
Yeah. Yield curve. I mean, like we talk a lot about this yield curve. And thankfully, the longer term yields are coming off. And even those shorter yields, we're going to start to see come down. But this is basically the difference between a 10-year yield and a 2-year yield. It's just showing you. So the difference between a 10-year and a 2-year, Meaning right now, where we sit on the end of that chart, the 2-year yield is that much higher than the 10-year yield. So
Right.
almost 1% higher than the 10-year yield.
Right.
Means that today, if you give me money, if I'm a bank and if I'm a whatever, if I'm a bond, you're buying a bond, you give me money for 2 years, I can pay you a greater return than I can if you give it to me for 10 years.
Right. Very
Same,
weird.
yeah, well, it's the same thing that rates are telegraphing, right?
Right.
Variable rate is higher than a 5-year fixed rate because people are saying, you're going to have to give me a really good rate to lock my money up in this environment for 5 years,
Right.
rather than being able to absorb these new negative rate movements that we're going to see, right? Over the coming, what people
course.
believe to be the coming 24, 36 months.
Right.
So what I will say to this is, like, it seems as though so far the bond market has got it kind of wrong, because there's been this expectation that interest rates are going to pivot and move down faster.
Mhm.
And the Federal Reserve has been telling Americans, I mean, Canada to a lesser extent, but the central banks, we'll just say, have been telling people that rates are going to stay where they are for at least a year.
Right.
And
Do you think that's true?
yes,
Yeah.
I think it's true. It's probably wrong,
Right.
but it's true because they're so afraid, because they've been so wrong in the past,
right.
right? Like, eventually, if a central banker continues to make mistakes, you lose confidence in the central bank, you lose confidence in the policy. Some of that tongue wagging that we spoke about earlier, like the speech, economic theater, loses its potency, and then it forces the central bank to actually make monetary policy decisions as opposed to talking about monetary policy decisions.
Right.
So when you lose that tangible effect of economic policy speech, forces you to act.
The Bank of Canada sounds like a really bad employee. The way you're,
Oh yeah, why?
you know what I mean? Just like all talk, no action. You know what I mean? Like, you know what I mean?
Mm-hmm.
Like, there's so much behind what they're saying that they don't actually have to work. In some
No, they
instances.
definitely have to work.
Yeah.
I think. Okay, so maybe they're a bad employee because they got things wrong,
Yeah.
right? But I don't think that they're a bad employee because, like you're saying, they're all talk.
Right.
I think the best hope for a central bank is that they don't actually have to make moves. They can just issue statements,
Right.
right? Like, that would be amazing, right? If you get to this point where the economy is like just sliding along, and these massive, like, 4-point increases in the overnight rate don't have to happen
Mm-hmm.
because you're adequately prepared. You've got your finger on the pulse of the economy. You really are kind of honed in with leading indicators. The problem is that the central bank doesn't operate in a vacuum.
Right.
There's other external influences that are impacting it, right? COVID is an external impact.
Right.
The war in the Ukraine, impact. So it's impossible to foresee all of these impacts and how chunky they're going to be on the economy, or how muted an effect they're going to have on the economy,
Right.
unless you are the guy from Quantum Leap. What I'm saying is, like, unless you've got the newspaper from 3 years ago, today,
Yeah.
3 years from now. I actually have 3 years ago's newspaper.
Yeah.
Unless you have the newspaper for 3 years ago, 3 years from now today,
Yeah.
it's how do you navigate all of it?
Right.
And you know,
Yeah.
so but really, like, that's what every central banker would wish for,
Right.
And then that would be, if they had that, they could just literally, back to the George Clooney joystick,
Yeah.
with just talking. So the best version of a central bank would be one that can just issue a statement and move and course correct things just exactly how much they need it to.
Just a wee little.
And then the economy would constantly have the same inflation, and it would be stable. You wouldn't see massive swings. People would have confidence. This utopian world.
Yeah, it sounds good.
Yeah. But that utopian world doesn't have, like, little tiny Vladimir Putin pushing bomb buttons all the time.
Yeah.
Right?
Yeah.
Unemployment rate. This is the problem. This gets cited all the time. The labor market in Canada is tight. People are looking for employees and they can't find them. And that makes an economy difficult to navigate with increasing rates. So the central bank is saying Bank of Canada is saying yeah, man, we want to drop rates, but we need to see unemployment rise.
Right.
We need to see more people looking for jobs.
This is percentile. This is percentage?
Yeah. So when we see this unemployment rate start to go back up again, it'll give more fuel for the Bank of Canada to reduce rates. Yeah. So that's what I had to say today. I mean, so my concerns going forward are the next 12 months are going to be tough.
Do you think that we're going to be in a Mad Max world in the next couple of years?
Again, external impacts, who knows?
Right.
But no, I don't think we are going to be. I think that over the next 12 months is going to be a little tough.
Mhm.
I think that interest rates are going to stay high for 6 to 12 months.
Mhm.
And I would tell you it's more likely they're going to stay high for 12.
Mhm.
And it's probably too long for them to stay high. I think that if interest rates drop sooner than 12 months from now, the problem is that something really bad, something broke in the economy.
Right.
And we got to fix it. And then it's going to be like my 8-year-old driving my car. Right? Turn right. Okay, no. Left.
Yeah.
Right? It's too much course correcting back and forth is going to just leave us with a headache. And it's just, it'll be more problematic. Less confidence in the central banks. But hopefully that doesn't happen.
Fingers crossed.
Yeah. Cross everything, man.
Yeah. Fingers, toes.
How about you? You would know, right? You're speaking to a lot of people on the phone, right? People that are calling in, asking for help on things.
I mean, the amount of conversations that I have, the amount of times that I've heard the shock in someone's voice when they get their renewal documents, it's quite sad, right? I have a few clients right now where they're just I don't know how I'm going to afford this going forward. I'm going to have to sell my house if I can't do it, if I can't do something else, right? There are things that we can take a look at, to help aid on your monthly payments, depending on your situation. But, some people don't have an option. It's quite sad. So,
and unfortunately, that's what needs to happen.
Right.
So we're seeing it, right? We're seeing people under tremendous financial strain.
Mm-hmm.
And it is so unfortunate. It's harder to do our job in these times, right?
Right.
It's much harder.
Yeah. Emotionally.
Yeah, for sure. It gets emotional.
Yeah.
But you just have to try to kind of do the same thing that you're doing, right? Identify the timelines, identify the cash flow. See, ideally, we don't want people having to sell at the lowest point in the market.
Mm-hmm.
We also don't want people to erode too much of their equity servicing debt at a time like right now when debt servicing costs are too high.
Right.
People have to also understand everybody's blaming the consumer.
Mm-hmm.
It's not really the consumer's fault,
mm-hmm.
right?
It's the foreign buyers.
Yeah, a good one. That was good. It's not the consumer's fault. Definitely not as much as it is the foreign buyers. It's not the consumer. You can't blame a consumer when you tell people not to work and that you're going to pay them.
Right.
And you leave interest rates really, really low. You keep printing money. And you tell people that interest rates are going to be low for a long, long time.
Mm-hmm.
These are all things. These are all statements and events that occur to the consumer.
Right.
So what is a consumer going to do? They're going to binge on the confidence that rates are going to be low for a long period of time,
mm-hmm.
and the capital that's been provided to them to stimulate the economy.
It's a heyday.
Yeah. So not knowing the impact of those things, we can say all we want that it's the war in the Ukraine. It's not inflation wasn't created by the war in the Ukraine.
Mm-hmm.
Inflation was created by the governments of mostly the G7 nations.
Right.
for firing up the printing press,
Right.
and the central bankers for leaving rates low.
Right.
So congratulations. Let's not blame Putin for all of it.
Mhm.
But now we have to address it.
Have to fix it.
Right. But don't tell me that, like, it's the consumer's fault.
Yeah.
So that's the part that pisses me off. It's like you got these consumers now that, like, it's like they're the cows in Yellowstone, right? Like they're just getting like pushed into one area from another area.
I also haven't seen that show.
Yeah. Maybe I'm watching too much TV. Anyways.
I was thinking it's more like the kid who breaks something when the teacher's not looking, and then he's like, it was him
Yeah.
or her,
Yeah. Lots of analogies today.
Yeah, and I'm going to have to watch Yellowstone and perhaps Quantum Leap. It was great. Like I said, graphs made fun. If
Great.
someone can do it, Marcus is going to get it done. Oh, that rhymed.
Merci beaucoup.
Didn't rhyme. Fun, done.
See you next week.
Yeah, see you next week.
Now we're back on.
Yes, absolutely. See you next week, and see you next week, man.